Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for the weekend of Sunday, 4/17/2022. I took advantage today of the Good Friday light schedule and actually was able to get this done early, which is great because I've got a training tomorrow morning for those folks that purchased my wealth charts marketplace package. I titled today, Rising Rates Break 30-Year Trendline Resistance. I could have also said a title of Surprising Strength Hidden Beneath the Surface, and I'll show you why. My email address is hgsidoc@gmail.com. At the current time, I do not maintain a user list or mailing list. So if you're watching this on YouTube, which is probably the only place you'll find it, make sure you hit the subscribe, turn on the alarm so you get notification. If you like this, thumbs up. If not, thumbs down. And I'd be very pleased if you left a comment. Constructive. If you like it, let me know. All right, let's go. Disclaimer, this is for educational purposes only. Any recommendations are in the spirit of education and should not be considered investment advice. I am a doctor, not a broker. Any tools I demonstrate are those I use in my daily trading. I've paid for all the tools. Trading involves risk, and you are solely responsible for any investment decisions you make. This is not trading advice. I am not telling you what stocks to buy, where to buy them, where to put your stops. I'm showing you how to use a tool. If you want more information, there is going to be a live seminar in Orange County, June 17th to 19th. 4 speakers. I will be live. The others may be live or virtual, depending upon their ability to travel. If you're interested, Greg Mills is the head of the local trading group that's putting this on. GAM72054@AOL.com. He can hook you up. It's a relatively inexpensive seminar, probably less than $500. They like to keep it down, but it's also a small group. You'll learn from long-term traders and software developers. I'll be talking about my Keep It Simple method of top-down investing. Dev talks a lot about day trading stocks and how he stalks stocks to take. Dave McMullen has some great strategies to protect your wealth. Hopefully he'll talk about how he will deal with a bear market if we see one. And Chris White is the proprietor of Edge Rater, and he shows us how to enable great trades. Hope to see some of my YouTube followers, my Wealth Charts followers at that meeting. That's it for the PowerPoint. Let's take a look at the markets. Remember, I did say something about surprising strength underneath. I promise that I'm going to show you something that might surprise you. So let's start by looking at the market. So let's just highlight this. And we'll start with the current sort, which is percentage off 52-week highs. You can see ARK Innovation ETF is 55%, Bitcoin's down 49%, the IBD 50 ETF 30%, Biotech 26%, FANG 25%. So clearly there's been a lot of damage in the market. Right now, the Russell and Nasdaq are living right below bear market territory at around minus 18%, while the Dow and the Spiders are down 6.8% and 8.80. That's not the most that they've been down, but they're down a lot less than the smaller, more speculative stocks. If we look at the week and we want to say sort it here, data, sort, let's just sort by 5-day performance. And let's go largest to the smallest. You'll see that the leaders this week were oil, commodity, silver, and gold. Interestingly, the dollar as well. You'd almost expect them to go the other way. And the biggest laggers are the things that have been down so much, the ARK, the Bitcoin, the FANG, and the 20-year plus Treasury bond ETF. So it was a tough week in the market. If we look at the major indexes, the Russell was down the smallest, minus 0.3 on the week, although it was down over 1% on Friday. The Dow was down 0.5, NYSE 0.7. The spiders were down 2.4, and the Nasdaq was down 3.9. So it was a tough week, and you could see down here that none of the sectors are at their 52-week high, and the closest would be consumer staples and energy and utility. And then healthcare follows. Perhaps we could take energy out of the next comment, but clearly defensive plays are outperforming, certainly right now. Energy probably has multiple drivers. Now, the first thing that surprised me, this is a warehouse report. I put every stock that's in the HGSI universe that has more than $2.50 and 250,000 shares. I put that into this set, and I asked the question, what was working this week? And it surprised me. I look at three characteristics: earnings per share rank. As we go to the right, the higher, the better the earnings per share rank. On the left is a performance scale, relative strength rank, and then group rank. And this was an interesting week because high ERG is what I like to trade, are stocks with high earnings per share, relative strength, and group rank, leaders in the right groups. And it hasn't been working of late. But notice the curve right in the center here is clearly going from lower left to upper right. And what that tells me is we're seeing better performance in the higher stocks. Is this a one-week wonder? Or is it a sign that maybe the market is turning around? I'm going to show you positive points and negative points tonight. No, I'm not bullish, but I was intrigued. This is part of it. And you could see the high EPS ranked stocks were up. The best performance were in the high relative strength, and often IPOs and stocks that had not been around to get a relative strength rank do well as well. And the stocks that were in the better groups did well. Now, if we look at the Nasdaq, no Hindenburg Omen this week on the Nasdaq. You can see the Nasdaq was down 3.9% on the week, 2% on Friday, and it's down 17.6 thus far, off of its high, so not quite in bear market territory. This, if the bar is, if it's colored, it means there's more than 2% of that performance or new lows. There's nothing with more than 2% highs. When you see a lot of new lows, that's not a bullish feeling. There have not been any of the signals here, which we'll talk about in Orange County. The NYSE, and this is interesting, and I know my friend Kathy from where I used to live in Old Palm is going to not like this slide because there is a discrepancy among programs about how many HINDYs we've had. There's pretty much concordance on 4, 6, 7, and 8. So 3 HINDYs is enough to me. Takes 2 within 30 days to be confirmed. And I'm going to show you before I go and look at wealth charts of why I get concerned when I see Hindenburg Omens. Like the Nasdaq, you could see lots of new lows. And I should have colored that, so let me color this right now. But unlike the Nasdaq, on the NYSE, which is a bigger mixture. You've got energy in here that you don't really have in the Nasdaq. You're seeing new highs as well. And you could see the NYSE was relatively flat on the week, especially compared to the Nasdaq. The buckets, just to remind you, I take every stock in the S&P 1500, assume that we put a Bollinger Band on them and ask the question, how many are above the midline in the Bollinger Band, or in this case below, 2/3 below? That is bearish. In an uptrend, stocks have a tendency to move between the upper part of the band and the midline, and in a downtrend, they'll move between the midline and the lower band. So the fact that 2/3 are below the midline suggests that most of the stocks are in a downtrend. And if I look at what decile we'll find most of the stocks in, it's in the lower part of the bands. Now, interestingly, very few stocks below or above the bands. And I look at a number of different stretch, overbought, oversold indicators, and none of them were blinking and saying we're going to bounce on Monday. Could always happen, but we're not oversold enough if that's the thing that's going to drive it. Now, what's driving inflation when we know so much of it's energy? And if you look this week, except for European gas and methanol, energy was up big. Oils were up over 10%, natural gas 15%, gasoline 11%, heating oil 15%, coal up 10%. That's a big feeder, in my opinion, on the inflation in this country. And look at over the past year, look at coal up 235%, natural gas up 175%. You could see how strong energy has performed, and this is across the board. Some of those natural gas numbers from Europe are probably being impacted by some recent trade deals with the U.S., but if you look at it over the last year, they're up massively. If we look at the metals, not nearly as impressive year to date. Most of the metals except for gold and lithium are down. Lithium, I'm not getting answers anymore. I'm not sure if it's not being reported or if it's because some of the things that are going on with China. On the week, gold was up a teeny bit. Silver was up a little bit more. Steel and iron ore sold off, yet, as you'll see, didn't necessarily hurt those stocks. Interest rates. I went back to 1995, and this is in TC 2000, and I could have probably drawn a trend line connecting these dots here as well. The bottom line is, on the 10-year, the interest rates are shooting straight up. On the 30-year, they're shooting straight up. Now, the 30-year has run into 30-year resistance. 30-year resistance. You would think that 30-year resistance would be pretty tough to break through, and that we might bounce around a few times if we don't just turn around there. Look in the past how we turned around, we turned around, we turned around. Well, the 30-year is still negotiating that decision. Look what the 10-year did, went right through it. So interest rates are a major problem. And will continue, I think, to weigh on the market, especially if they continue to go straight up. Now, this is the Fed spread, and during times of tight money, it will come up. It'll go up in a bear market. It went up in the 2020 rollover. Now, it's off the lows over here, but it's really not doing much, so I'm not going to worry too much about that. And here's that famous 10-2 yield inversion where we went below zero and bounced up. Now, it's when we bounce up is that we usually get into trouble. So, this is predicting recession in the next, here's the problem, 6 months to 2 years. It's not perfect. And if you look back over 20, 30 years, recessions happen. So is this casual, or is it just something that happens, and so do recessions? The problem is everybody talks about it on TV and in the papers, and it's clearly driving some of the negative sentiment in the market. Not a big news week compared to last week. Got a beige book from the Fed on Wednesday. Some home building stuff. Jobless claims as always on Thursday. PMI on Friday. Not nearly as massive market moving news as we saw a week ago. However, boom. This is earnings, and this is the heart of the earnings season. And over the next 3 to 5 weeks, these are some of the major stocks that will be coming out with earnings. But over the next 3 to 5 weeks, most of the major stocks in your portfolio, in your wealth management portfolio that somebody else is managing, in many of the mutual funds, many of those stocks will have earnings. So this could be a whopper of a week. It's a judgment call whether or not you want to hold stocks over earnings or not. It's bad judgment to not know when that earnings date is coming. So, technology led the market lower this week. Ukraine continues. News will continue to drive the markets. Energy's up. Oil again above 100. Ukraine war showed no sign of ending as a Russian capital ship was sunk. Love it. It was called the Moscow. Additional forces are rushing towards Ukraine, and the banter between the U.S. and Russia is increasing as the U.S. is sending some more significant war material to Ukraine. The markets seem to be discounting now multiple 50 basis point raises, and the markets this week were weak. They traded down from the open Monday, and despite a nice rally on Wednesday, closed down on the week. We are going to get rallies. The question will be whether these are new bulls or just relief bear rallies, bull traps, short-lived, and reverse painfully. I think the fact that we had those HINDY signals concerns me. Be nimble, trade the market we have, not the ones on TV say we should have. Less news this week, but I showed you the earnings. April seasonality, which is supposed to be the best in the second year of a presidential cycle, not doing so well. And again, we're in the worst year of that presidential cycle. Now, I talk a lot about the Hindenburg Omen, so let me just show you why I care. Here is the market in 2006. And just take my word for it, it was going up and hitting a new high here, or a high here. And you'll notice these red lines here. This is in that HGSI program that I often use as well. These red lines fire when you get a Hindenburg Omen signal. And notice, after multiple signals, the market ran up for a while, and then it rolled over. And you could see a pretty 87.22 down to 76.52. You know, is that horrible? 15%, 20% pullback in the market. Here we are over here, 2007. There's your Hindenburgs. And what happened? We broke down below the moving averages. We failed at the 200 on a retest, and that was all she wrote, folks. Now, this kind of reminds me of where we are right now. So every time we fail at these major moving averages is not a good sign. And I think you know what happened in 2007. What about 2015? Everybody says we've been in a bull market since 2009, at least until 2020. Well, here we had 4 or 5 signals fire, and then the market rolled over and took a pretty big dump from 11,300 down to less than 9,000. It's another 20% problem. All right, let's move forward. 2018 didn't seem like much happened bad that year. We had a lot of Hindys fire, and look what happened. The market rolled over from a 13,700 range down to 12. So maybe not as big as some of the others, but still a nice little painful pullback. And then 2018 was a double whammy. We got a second set of HINDY omens, and later after the year in October, we did it again. Dropping from 13.2 to below 10.8. That's a big one. Another 20% drop. And then we all knew what happened in 2020. And when you heard all those things about the fastest drop, well, if you look at these other drops, none of them look like this. And we've known the recovery has been pretty ferocious. What preceded all of these? What's only on the left-hand side of the chart? The Hindenburg Omen. Do we think this is real? It's up to you. A lot of people think it's make-believe. I believe it. Learned about it from my mentor Ian Woodward decades ago, and I take it seriously. Let's jump into wealth charts, take a look at where the market is today, and come up with some thoughts of where it might be going. So here is the spider. Beautiful uptrend, broke trendline support here, which is back in the beginning of the year, sold off pretty hard. This January 24th reversal low, which I've had on the charts for weeks, we retest. This is where we hit it in January. but it was also resistance back here in April last year, and then support over here. This is probably a pretty critical line. As long as we stay above that line, the bulls have a chance. But right now we are in a choppy, difficult to trade area, and we failed. I thought we broke above the 200, and then we had a pretty rough dry down. Hoped we'd hold at the 50. We bounced around. We broke down. If I had to be bullish or bearish looking at this picture, I've got to be bearish. What's going to change my mind? Well, if we can close and hold above the 200 and start seeing some higher highs and higher lows, that will be helpful. At least get me back between the 50 and the 200. But right now, it's hard for me to be anything but bearish when I look at the spider. If I look at the Qs real quick, similar pattern, broke down below the 50. Notice all three time frame bongos are red. Failed at the 200. We've seen that before, didn't we, after seeing some Hindenburg Omens fire? The diamond's a little different. The diamond is still above the 50, and that is something that's important. You know, right now it looks like it's just going sideways between the 200 and the falling 50. I mean, that would probably be optimistic if it stays there. But let's see what happens. It'd be nice if it stays there. If I had to pick here, I'm more thinking chop, but that's not bullish. And if I look at the Russell's also got problems where the Russell, this was a Darvis box that started somewhere back in here, February 2021, and notice how the stock traded between these lines. We have tested this multiple times and failed. That is major resistance. Right now, here's the January 24th support. And best case right now, I'd say, is we're chopping between resistance and support. A breakdown below the January 24th lows on any of the indices would be concerning. So again, how can I be anything but bearish? Now, I mentioned some things that I saw that might be a little bit confusing. One is, this is the VIX. The VIX really didn't do much on this week, despite a very negative week in the market. Maybe it's just loading up to run. And notice it does have green bongo daily and weekly, which we haven't seen. And the dollar remains to be very strong, which to me is great if you're in cash, perhaps, but not necessarily great for the market. Now, I mentioned I saw things that surprised me because I'm expecting this market to look awful. So every week I accumulate a lot of different watch lists. And I actually put all the stocks and all these watch lists in a large file, and I spend most of my weekend going through the charts one at a time. That is a bottoms-up approach, and that's what I do on the weekend. During the week, I'm all about top-down, but I built a list I call the combo buy list that includes the best of the stocks from all these lists to combine. So when I see all the major indexes are down, and I look and I see most of my groups I looked at are up. The stocks I had this week, well, I had a couple of really good players. Oil, gas, coal were up 2.7%, 17 winners, 10 losses. That was a good week. I have no complaints. Now, if I look at the S&P 500, I think this is the line. It was down 0.5%. Really flat. If I look at the IBD 50, it was up a tad this week. Oops, that's not it because there's only 16. The IBD 50 is, let's see if I get the right one. This one, up 0.37. So not a bad week for the IBD 50. The IBD weekend review, which is a lot of stocks, was up 0.66. The MarketSmith 250, which is really 300, was up 1.46. And if you look at the stocks that led, it's stocks that have earnings, high relative strength. My filtered buy list, which is a very tightly dissected list. So you could see, despite the fact that the markets were awful, most of the groups, and these are probably because they're high relative strength things, but most of these groups were actually up. So maybe that means something. All right, let's continue looking in wealth charts. Commodities. This is the big one to talk about, which is the 10-year, which just rockets to the moon. I already mentioned it. And if the 10-year is high, one will expect that we'll be seeing defensive plays and bad for growth. If we look just to the left, you could see gold and oil are off their highs, but both of them are in short-term uptrends as well with green weekly bongos. And natural gas has just gone bananas, although maybe that's a shooting star. Nope, it closed at the high of the day. So natural gas is still going bananas and is extremely bullish looking. The guppy charts, I'm going to say one thing. They look ugly. All of them are trading below their band of moving averages. It's in to me, a no-go long territory. Hard to understand what I'm going to do based upon that list of the different, we call it the group performance analysis. And it's something I use all the time. You'll see it in my videos going back years. And this was looking at stocks list that I created a week ago on Friday the 8th. And I looked at performance from Saturday the 9th until today, which didn't trade. And so this was prospective performance based upon lists that I built last Friday night. All right, market theme, rates are up. So we got large cap outperforming small cap. This is just a ratio chart. You can look at the hourly, and it looks even worse. Actually, it looks a little different, I should say, where small caps over the last couple of days started stirring. Remember, the IBD 50 was actually up on the week. But if we look longer term, we see we're coming up here, we're large cap. So large caps for the most part in charge, but we're in the midst of a pullback in this ratio chart which favors small caps. And then it's hard not to say that value's in charge. Even if I look at the short time, when you're heading towards the right lower quadrant, you're favoring value. When you're up at the top, you're favoring growth. So it's been small cap value, large cap value, and now we're seeing some perhaps, I'll believe it when it persists longer, some interest in the small caps. Now we can look at the S&P 500 sectors to get a sense of what's working this weekend or what this week. And what we're looking at are 1 hour ratio charts. And the things that are up here in the upper right hand corner are outperforming the spiders the most. So materials, energy, staples, utilities, healthcare. What did I just describe? I described a lot of defensive plays and inflation plays. All right, so now let's go look at the dashboards. I'm going to look at my marketplace dashboards because they have a few other indicators, but I want to look at the scanner. Now, top-down investing, which is what I do, means I start with looking at the sectors. I identify those sectors that I think are outperforming. Then I might look at the industry groups within those sectors that are doing the best. And then I might look at the stocks within those industry groups that are leading the market. That is called top-down investing. I could then make sure I've got my bullish weekend review as my default, and then I can hit add to watch list, and the stocks that I identified that were in the top indexes and the top sectors go to my watch list. That's top-down approach. Now, maybe I want to do a bottoms-up approach. In a bottoms-up approach, I might take all the sectors and all the industry groups, and I might say, just using the algo score, take me everything above 750. So this is all industry groups, all stocks in the market, and I should capture those stocks that are leading. Much easier to do this because I'm just taking the top stocks in the market, not looking at the industry groups. But I think you lose something. Add it to the watch list. So now I've got a watch list that contains stocks from both the top-down and bottoms-up approach. And now I can do various manipulation of that watch list to define if there's any stocks that are working. Now, I really do on Friday nights and Saturday look at every stock in every one of those lists. Now, I trim it down on price and volume, and usually it's somewhere between 850 and 1,350 stocks. And I can do it very quickly, and I'm looking for specific patterns. Now, I don't need to do that. I actually like to do that, but don't tell my wife I said I don't need to do it. So what I've done is I built that watch list. I've already built one for the bears. I'm not going to build that for you right now. We know that it was a tough week, and you can see right here that on Friday the only thing that was up was energy, and despite the indexes being down on the week, we did have some brightness with energy up 5.25, materials up 2.5, followed by healthcare up 1.14, which is kind of interesting on the week. Now, Wealth Scanner is one of my favorite tools in wealth charts because it allows me to build lists of ETFs. So if I go to watch list, let's see if I can even look at that. I don't know if I'll be able to see that or not. Here's my top-down indexes. So I'm not going to do it now, but you could see I've got S&P sectors, index ETFs, different commodity ETFs. And the point here is I wanted to create a list or a data set of many of the ETFs that might give me a clue as to which things are leading in the market. And in Wealth Scanner, if I look at those from a bullish perspective, I can see gold, utilities, short the bonds, energy production, natural gas, dollar, energy, agriculture, REITs is a new one, and then materials. I could go all the way down if I wanted to, but I'm not going to. But you can see dividends and value are here as well. So if I'm going to go fishing from a top-down perspective, now since I think the market is most likely bearish, I'm not sure I'd be going all in on technology or even financials. But it turns out that I'm bearish, but I'm also impressed with the strength in materials and energy. So if I go into my scanner, and the reason why I have the scanner is to make my life easier. So what I've done here is I've looked for stocks over $5 and 500,000 shares, at least one bullish dot. They can't have more than one bearish dot. It has to be less than one. And I'm going to go with the squeeze. If I take the squeeze off, I'll get a lot more stocks. And then I'm going to rank these, and I'll tell you about this list in a moment. So this is a list of this is my favorite 600 stocks. And it's stocks that come from published lists by good sources, my own scans, my TradeStation scans, lists that others share on the web, and I basically combine them. And I found that this list basically is a good place for me to fish from. And those that are part of my marketplace package, I'll show you how you can get that from me tomorrow during the program. So why do I rank by the dots? Because the dots stand for volume, breakout, momentum, and big gap up. So big gap up, momentum, and breakout are all better when there's volume behind it. So the more dots, the better. The squeeze is simple, Bollinger Bands inside the Keltner channel. The EMS is a indicator that I developed that I use in other platforms. It's not been one I've talked about historically. It's sort of been a secret weapon of mine. It's a very fast moving indicator. So what comes to the top? Caterpillar. So it's an industrial stock, but one that's involved in the agricultural business. And with agriculture doing well, this might be a good play. So if I look at Caterpillar, what do I see? I see a big uptrend on the weekly, a pullback, and that's been going sideways for 8 months. So now is it ready to break out? Well, let's look what it did on Friday. I've got my EMS signal firing on massive volume. Down here I get that the green dot here is the volume dot. Then I have the breakout dot. I've got the momentum coming from a squeeze, a PSA reversal. All 3 time frames are bullish. And this is my high jump bar, which is a part of the marketplace indicator. And at 91, it's telling me it's not maximally extended. So I would be potentially interested in this stock. So that's one I would put on my watch list. CCEP, this is Coca-Cola of Europe. It's way too far down in the pattern. Now I love this look here, but it's got the 50 and the 200 above it. So I'm thinking I'll pass. KBR, another one, again, big uptrend, pullback, breakout. That's what I like. And if I look down here, 66%, so it's not too far. All the bongos are green. 3 dots, squeeze, and a PSER reversal. I like that one. And I could go down this list, MTOR, that's a takeout. NOV is a oil services. It ran crazy with the price of oil at 130. It came back. But if you look at this, doesn't this look like it's ready to go again? 3 green dots and a squeeze. So that would be potential. So right off the top, just by looking at the dot stocks, I'm finding stocks to buy. Now, could I be missing things? Absolutely. But I want to make it simple, and I want to find a way that I could take a list of potential stocks and bring the ones right up to the top that I might want to look at more aggressively. Now, I mentioned materials were strong. So I could actually go into a list of material stocks, and I could see, without looking at a bigger list, that comes right up as BVN. Now I've been doing some daily videos on building a library before I start to release access to them. And BVN was my pick maybe a week ago, and it continues to do well. It's a inexpensive miner. I believe a South American miner, and it broke out. You've got a breakout bar and momentum from a squeeze. VAL, Valaris Limited. Don't really know this company at all. I think it might be, well, it's a South American, I think, although I'm not sure. And this has been in a beautiful trend, a pullback, and here it's got my EMS indicator. CENX is aluminum. Pullback, it looks like it's ready to run again. So I found some things in the material group. Now the problem with materials, a lot of things have already run. One thing that I might be interested in the material side is what about gold and silver? So do I have a gold and silver? I can't remember if I made one. I don't think I did, so let me show you how I could add gold and silver. I am going to create a new watch list, and I'm going to call it gold and silver. Then I'm going to hit create watch list. And now I'm going to go into the sector scanner, and I'm going to look for basic materials. I'm going to hit compare, and I'm going to find gold and silver. We'll throw uranium in there. It's a small number. Gold. And anything else, other precious metals, we'll take that as well. Okay, I think I've got the major ones I'm looking for. Now I want to compare, and these are all the gold and silver stocks that I have in the data set. I want to highlight all of them. So I'm going to go all the way to the bottom and put my shift mark on it. And now I'm going to go into the little funnel. I've got to change my watch list to gold and silver. Okay, it says I've changed to that watch list. Default watch list is updated. And now let's add these stocks to the watch list. Let's see, there we go. Symbols added to watch list. Now let's go to the watch list here and see up. That's top down indices. And there are my gold and silver. So over to CAT scan, and let's change this to gold and silver. And the one that comes up is BVN. So did you notice how easy it was to take stocks that were in a industry group, create a watch list, and then scan it? Now, if I want to see more of the offerings, I know what I have to do. I just got to take off the squeeze. So let's hit apply on the squeeze. And there's not much that pop up, but EGO, low cost gold miner, breaking out and running. KGC, another Kinross Gold, another one pulled back, sort of had a reversal day on Friday. Now the ones that I've been watching, Newmont Mining, Newmont Corporation, has really run a long way. And you can see it's at, it's up there in the 90s, not 100 yet. It didn't have a new buy signal. I want to buy this when it pulls back. I want to buy this when it pulls back. Right now, it's gone. GFI is another one. This is one that I own. And you can see it's pulling back. So now I'm going to wait and see, do I get an opportunity to buy it again? And if you look at what happened here, you had a bunch of the green dots firing. I like to see some dots occurring here in the squeeze. Another way that I'm playing gold has been a ETF that used to be 3x, now it's 2x, and that is Nugget, and I took it on this day here in a squeeze when it had big volume, and it's moved up since that point. Lastly, I want to look at oil. And lots of oil stocks are looking impressive here. And we looked at NOV, which is services already. If you notice, most of these are services. Chesapeake only had one. And the reason is because these stocks have been in big runs. And again, when do you want to buy them? I want to buy them when they pull back. I want to buy them when they pull back. And many of these have just had major runs. A couple that looked interesting, COP, which is ConocoPhillips, pulling back here. It did have my early signal. It's in a squeeze, and it had one green dot. So that's one that I thought looked interesting this weekend. But there's so many oil stocks that looked good. So I could look at any industry group. I'm just going to go back to my combo list, which is going to have most of these stocks that we just called out, which is why I like it. And let's just rank it by dots. CXW is a one of those private corporation prisons. I just don't know how that's sustainable. But they're doing well despite the fact with change in presidential side there was concern. So I showed you a lot of interesting patterns to the long side. What I do is I go through the stocks, I go through my scans, and I usually come up with a weekly short and weekly long buy list. And just, I know some people like to look at that buy list and Let's actually go to the watch list because that way I don't have any filters on. And then I just want to show you one or two things else that I'm looking at. So I'm going to find my buy watch list. This is longer than they've been. I think we're at an interesting time in this market. So unfortunately, I don't have the industry group in the sectors, but I can tell you there's a lot of energy and a lot of materials in here, and a couple of different shippers like GOGL, which broke out on Friday. The nice thing is the scan will not update until end of day, but I could be looking at the dots during the day, and GOGL had big volume, and that drew my attention to it. Another one that is in the same group that did real well on Friday was Starbulk. And so something must be going on with this group because several of them, which had been pulling back, had reversals and lots of green dots. So this is the stocks that I'm looking at on Monday, and all it means is I'm going to have a watch list. I may pick a couple that I like the most and put some provisional orders in, and I don't put an order in without a stop. Now, last week I mentioned a couple of things that you might want to consider doing. One of them I talked about is shorts and playing contra ETFs. So if we look at weekly return on the contra ETFs, Dust, which is, the gold one, was down a lot. But if you look at TZA, which is small stocks, it was up a lot on Friday, but on the week it was down. The S&P was flat. The dog was flat. The S&P and the Q contra ETFs were the ones that led, and those were the two indexes that struggled on the week. On shorting last week, I was looking at Google, and not for faint of heart. And the reason why I was considering Google was because it had just broken down through the 50-week moving average, and 1, 2, 3, 4, it had broken down on the daily, and it didn't do a whole lot, maybe about 40 points down on the week, because the problem was it gapped down and you couldn't get it until it got up here. So, well, more than 40 points, but from 26.42 down to 25.38, so rather 100 points or so on the week. But again, if you weren't in it already, you couldn't buy it until it got here. Now, would I be shook? Did I cover my short? Absolutely. Why? Because look where we're at. We're at 1, 2, 3, 4. The last 4 times we got to this level, we bounced. So some of the stocks that were really nice to short, Click was another one who've sold off. They're starting to get to levels where they bounced before. So have to be careful with those. So I guess that's enough talking. I think that I'm amazed by that group performance analysis that showed so many growth stocks doing well with the Qs and the rest of the major indexes selling off. Does that mean we've got a bounce coming? It might. Be careful of any bounce we get. And I look forward to seeing folks who have my marketplace package tomorrow. You all have a happy Passover and a very happy Easter, the rest of Good Friday. Wonderful weekend. Be safe. Thank you.